Good afternoon, everybody, and my apologies for the delay. We had a little bit of technical difficulty here on our end at ETF.com. My name is John Swolf. I'm the Director of Conference Content at ETF.com, and I will be your host for today's webinar. The idea behind the Emerging Markets Week was to gather a wide-ranging group of experts for our 5 standalone webinars looking at the critical topic of emerging markets. We have had 3 great webinars this week and look forward to continuing that trend today. I encourage you all to tune into the final webinar tomorrow and to watch any of the replays you have missed from earlier in the week. We're in for a treat today as we explore the topic of emerging market debt and currency. We are lucky to be joined by 2 of the most respected names in EM debt and currency. Joining me today are Rick Harper, the head of fixed income and currency for WisdomTree Asset Management. Rick oversees fixed income and currency product development, and he has over 19 years of investment experience in strategy and portfolio management positions at several prominent investment firms across the industry. In addition, we are joined by Bradley Crom, a fixed income strategist at WisdomTree. He is involved in creating and communicating WisdomTree's thoughts on currency and fixed income markets, as well as analyzing existing and new fund strategies. The format for today's session will be straightforward. I'm going to kick things off with a handful of housekeeping items, and then I'll turn things over to Rick and Brad. I will then jump back in with a few questions of my own, as well as take questions from you, the audience. At the end of the hour, I'm hopeful we'll have a few key takeaways that we can put to work in the market right away. But before we do get started, I have a few housekeeping items to run through. First, I would like to thank the sponsors of our Emerging Markets Week, CSOP, WisdomTree, and JP Morgan Asset Management. We could not produce this high-quality content without their support. We choose to partner with the best in the industry, and these 3 firms all offer excellent emerging market solutions. So please do be sure to go to their websites and learn about the products they offer. Second, we'd like to consider you, the listener, to be a participant in this webinar. As such, you can ask questions of our panelists at any time using the Q&A toggle on your webinar view. Please don't wait until the end of your session to ask your questions. Ask them as they occur to you. We'll collate the questions and answer as many as we can before the end of the session. Third, if you would like to enhance the viewing area of your slides, you may do so by clicking on the Maximize button on the upper right-hand side of your webinar browser, or by dragging and dropping the lower right-hand corner of the webinar slides. Because people always ask, a recording of this webinar and a copy of the slides will be made available to you on ETF.com's website within 48 hours of the completion of today's webinar. You will receive an email alerting you to when that recording is available. That email will also alert you to the process of obtaining CE credits for today's webinar. So if you are looking for those credits, sit tight after the webinar and we'll get them over to you later. Fifth, I would like to take today's webinar and remind you to check out tomorrow's final webinar segment on China. We'll be taking a closer look at the Chinese economy. You can find that on the ETF.com webinars tab on our homepage. We have a lot to cover today, and since we got started a little bit late, I do want to go ahead and jump out of the way here. So at this time, I'd like to turn it over to Rick and Brad. Rick and Brad, take it away.
Great. Thanks, John, and thanks, everyone, for listening in. This is Rick speaking, and Brad and I are really excited to be part of Emerging Markets Week and truly excited to be talking about a subject that takes up a lot of our time, emerging market debt and emerging markets in general. Now, recently, emerging market debt has been challenged by 3 primary catalysts: moderation in the pace and growth from China, faltering commodity prices, and a fair amount of anxiety over future Fed policy. And this has challenged valuations somewhat. And in financial markets, we know past disappointments often point to future opportunities. And to be sure, valuations in both currencies and interest rate spreads have risen to very attractive levels. The key to unlocking this value, to finding an entry point in terms of establishing positions, remains these same three catalysts that have pressured valuations in the past: stability in China, some stability in the commodity market, and a more gradual Fed as opposed to a Russian hurried Fed are essential elements into expecting positive performance from EM debt over the near term and possibly over the intermediate term. The long-term case for emerging markets remains strong. Weathering through the near-term uncertainty remains the challenge. At this point, we see external vulnerability as the primary issue related to emerging markets, not just sustainability issues. EM governments still have significant ammunition, as we'll discuss later, to weather potential disruptions. And they've simply grown too vital to the global economy for investors to ignore. Yet, in recent years, we've seen investors significantly scale back their EM investments. And currently, they remain largely underweight EM as a collective asset class, particularly given the importance of EM economies to the global economy. Now we're going to go back to these three catalysts, and we're going to talk about this a lot during the course of the webinar. But you can really see the influence of commodities, China, and Fed policy in the graph in front of you, and their influence on EM debt in general. Now, the orange line represents EM local debt. And you can see that it withstood and continued to rise during the initial stages of the Chinese slowdown, as well as the initial slide in commodities. It was when Bernanke had the shot across the bow that initiated the taper tantrum, is when valuations in EM debt peaked and started to climb. They accelerated as Chinese growth and the commodity slump of last year became front and center. And those issues remain in the headlines today, and obviously they influence greatly the path of EM debt going forward. But what attributed for poor performance in the EM debt? You know, the primary driver of both asset valuation declines in local debt as well as equity markets has been currency related. And this is very, very obvious if you compare the royal blue line at the top to the navy blue line that falls somewhat below. Now, the royal blue line represents the total returns provided by investments in local debt in local terms, so without currency fluctuations. And you can see they actually did extremely well relative to other dollar-denominated asset classes that Brad will talk about a little bit later. But the influence of the currency and the currency depreciation that we saw had a stunning impact on the valuations and the returns achieved in local debt when you were translated back to dollars. And what we've seen is many currencies have been pushed to 20-year lows relative to the US dollar, including the Brazilian real, the Mexican peso, the rupee, and the South African rand. Some Asian currencies are also revisiting levels that they saw during the Asian crisis in 1997. And the Polish zloty, sort of the benchmark currency in EM exposure within Eastern Europe, you know, is at weaker point relative to the dollar than any point during the Euro crisis. Now, what this does do, inevitably this creates value among EM currency from both a nominal and a real perspective. The real effective exchange rate is a valuation metric which contrasts the value of a currency relative to its trading partners and adjusts for inflation. You know, it's an evaluation metric that's often used to discern the real standing of a currency relative to its trading partners. And you can see, as of current valuations, many prominent EM currencies are significant discounts to the long-term averages. And as Brad will touch on later, spread widening within corporate and dollar-denominated markets has also risen to very attractive levels. And what does this create? This creates value, potential value. Now, the question becomes, what degree of conviction and confidence do you have that the long-term story for EM is still intact? Dented, but still intact. And I think the only way to really look at it is to start with an assessment of the macro fundamentals and the conditions. And then we're going to view these conditions in the context of the actual debt markets that underlie them. EM countries continue to pace global economic growth. The scale of the growth premium offered by EM countries over developed markets has declined in recent years to many people's surprises. The initial projections by the IMF, the International Monetary Fund, in 2010 suggested relatively consistent EM growth at 6.5. Obviously, we haven't gotten that, with growth decelerating to 4.7. They also expected a 4% premium over DM developed market growth to be maintained. That has since slid to 2%. The growth premium was essentially cut in half. And I think with these large-scale revisions, many observers are very skeptical about whether we'll actually see the inflection point in the growth premium, as you can tell by the V in the orange line up top, that we anticipate to see this year or in 2016 or early 2017. Now we've seen rotation and growth throughout EM in different countries, and right now most expectations are that EM growth will pick up over the next few years. This brings us to the context I see repeatedly in newspapers and the media that whenever there's sort of a speed bump in EM, the first thing many investors do, they quickly jump back to early crisis periods, searching for a reference point, and we're all guilty of this. And I think often people fail to acknowledge the inherent differences in EM then versus now. You know, relative to 1997 and the early 2000s, EM economies have much deeper financial markets. Most economies have shifted from a fixed currency exchange regime to a floating exchange rate. And government issues have shifted from issuing strictly dollar-denominated sovereign debt to locally denominated sovereign debt, mitigating the problem, the original sin problem that Brad's going to talk about later. And from a global standpoint, the EM contribution to growth has expanded greatly. Back in 1997, EM countries contributed 22% of the world's growth. That number is now 40%. In terms of the degree of the 11 trillion in FX reserves that are currently held across the world, EM countries now hold 52% of them. That's double what they held back in 1997. And to show the scale of the increase, in 1997, the world in general held nearly a little over 2 trillion in FX reserves. And emerging markets held roughly between 550 to 600 of those reserves. Right now, as I mentioned, FX reserves are 11 trillion and EM holds 5.8. And this growth and the additional contribution that EM economies have made to global GDP, you know, while debt has expanded, it has not matched the increase in the contribution from growth. You can see debt has gone up from 14% to 26% of the global total. This breaks down the EM reserves, the global reserves, a little bit more. And it's not just China. It's a common misconception. They do hold a large percent of the other reserves, currently about 3.5 trillion. But 7 EM countries hold at least 300 billion in reserves. 7 out of the top 10 country reserve holders are EM countries, and 14 of the top 20. Now, if you think about that 300 billion and 7 countries each having over 300, if you remember back to the number I just said on the last slide, that EM in aggregate in 1997 only held about 550. So 7 EM countries now hold more than half what was held by the entire bloc back in 1997.
So, Rick, looking closer at this slide, before we move on, obviously there's a fair degree of diversity across this list. Really, is there a minimum amount of reserves that you necessarily look for? And if that level necessarily gets breached, does that set off, potential warning signs that the situation might be deteriorating?
I think there are limits, but everything is country-specific and region-specific. And it has a lot to do with some of the economic differentiation we saw. Like a country running a current account deficit has a high level of external vulnerability. And actually we'd be very sensitive to the degree of any depletion of FX reserves. And when FX reserves fall below, say, 100 billion as a bottom line. But we also, for across EM in general, we do look at trends quite a bit. A lot of times it's not the level as much as the deceleration in the holdings and reserves that can really spotlight some trouble points. It's one of the concerns we've had with Malaysia when there was a significant drop in reserves, and you dropped all the way down to about 94 billion for a country that's normally had a great deal in excess of that. You know, it brings back, why is this so important, and why have we spent 2 slides talking about it? You know, reserves can serve as a shock absorber, enabling economies to weather past periodic periods of capital outflows and economic downturns. Now, in past crisis periods, that flexibility was scarce to non-existent, and now it's much more common. Now, if we look across EM, differentiation and economic fundamentals remain a key. You know, first, it's a common mistake that many investors make is they approach EM as one real homogeneous group, and nothing could be further from the truth. Conditions differ wildly between countries, regions, and more recently between commodity importers and exporters. Now, the growth in Asian countries has held up better than its Latin American and EM counterparts. Asian countries continue in large respects to hold a great deal of current account surpluses, where some of the commodity, particularly some of the Latin American countries, are struggling a little bit with some of their current account deficits. But one highlight, while we have seen initially some downturns in current account trends and current account balances, one of the benefits of a depreciation in the currency is the terms of trade become a little bit better from an FX standpoint. And that tends to be influence future growth prospects later from a turnaround in the current account balances. And we have seen the large majority of EM countries have seen noticeable improvements in their current accounts balances from the troughs they've seen over the last 4 years. There are some still problem standpoint, and Turkey stands out as a real tremendous outlier at the left side of the curve. But you also see a lot of countries with current account surpluses as well. And so this is a positive sign, it's a developing sign going forward. You know, in addition to current account deficit, another potential sign of external vulnerability is, from a currency standpoint, is inflation. And with a few exceptions, inflation is largely contained. With an average of about 3.3, but once you exclude some of the more higher inflation countries, that number drops down to 1.6, which is very benign and historically low for EM, and it largely reflects the disinflationary forces that are at work in the global environment as a whole. And I would note that Russia currently is biasing the 9% upwards in the exception category. Russian inflation is projected to accelerate to about 7% next year, so we imagine that number will come down. So at this point, you know, we've seen GDP has slowed, and it's moderated, but it does seem like it's potentially poised for a turnaround. Inflation's low in most countries, and it's conducive to a favorable backdrop for EM assets. Current accounts are trending better. Reserves remain high. And many central banks have the flexibility to tighten or ease. Asian and Eastern European economies are biased to easing next year, while Latin American countries are focused much more so to potentially tighten and raise rates to protect their currencies going forward. Again, the thought process is weathered but not broken, and the long-term case for EM is dented but still intact. You know, at this point, I'm going to turn it over to Brad to take those economic fundamentals and apply them to the bond markets themselves.
Yeah, sure. Thanks a lot, Rick. So I think one of the important points that Rick really brought up is kind of the evolution of emerging markets as in terms of their contribution to global GDP. And I think that for a lot of investors' portfolios, really emerging markets have grown to the level that really they're largely too big to ignore. So if we're talking primarily in this webcast about the various options that investors have for accessing fixed income markets in EM, I think it's really important to put the evolution of the asset class in perspective. So if you look at the green line, this is going to represent dollar-denominated debt issued by emerging market governments. So you see that this asset class really got its start back in the early 90s as part of the Brady Bond program that really was instrumental in helping to rebuild Latin America in the early 90s. So really what you can see is that over the next decade or so, emerging market economies continue to grow. They continue to mature and develop a credit profile. And largely at that point, you saw a migration from dollar-denominated debt to locally denominated debt. So one of the primary issues that we have with dollar-denominated sovereign debt is this economic concept known as original sin. So this is really a risk that economists see, and it's largely talked about in the news today, that in the instance that a government issues debt denominated in U.S. dollars, well, at the time that their economy starts to come under pressure, their local currencies begin to depreciate, ultimately increasing their long-term liabilities in dollar terms. So really, during a period in which you're less able to pay, your long-term liabilities are increasing, and ultimately that puts lenders as well as issuers at greater risk. So one of the alternatives to that is that a lot of these dollar-denominated issues would enter into long-term swap contracts with banks to help offset some of that risk. However, that ultimately increased their overall cost of borrowing. So as this market ultimately began to mature, the more credit-worthy borrowers were able to transition to local currency debt issuance as a way to help offset that asset liability mismatch, whereby they're borrowing in local currency and they're ultimately paying that debt back by the tax revenues that they're deriving in local currency as well. Over this time period, you've seen a dramatic increase in local currency issuance, but I think one of the notable elements of this is that the blue line that represents this EM local currency debt is much more jagged than the other two. And I think that that's important, and it's something that certainly investors that have invested in EM local debt have experienced over the last 4 or 5 years, that overall the value of those investments and the overall value in U.S. dollar terms of the investable universe is subject to the value of the U.S. dollar against these foreign currencies. Now, one of the other interesting elements in terms of the evolution of this market is that largely as the more creditworthy, larger, more integrated emerging market economies began to issue in local currency terms, this opened up the market for corporations to ultimately borrow in U.S. dollars in order to help finance their businesses and tap international demand for emerging market credit risk. So I think it's very interesting that really over the last 20 or 30 years, you've seen an evolution in the market that's grown from $100 billion in debt outstanding to a market that's well north of $2 trillion in the current market environment. So I think that for global fixed income investors, emerging markets still offer a fairly interesting option for increasing allocations and adding higher income potential to their portfolios. So in the same way that we just talked about the various evolution of the asset classes, I think this chart does a great job of also summarizing the key risk and return trade-offs available to investors. So if you look in the far right column of the left chart, certainly one of the key reasons that investors have historically been attracted to emerging markets is the higher income potential or yields offered by taking on emerging market risk. I think local debt also offers some of the lowest amount of all-in interest rate risk for emerging markets, as well as being the largest amount of debt outstanding, providing adequate liquidity for global investors to tap as well. However, given that not all emerging market issuers are able to issue in local currency debt, it does have a more limited subset of countries that can necessarily tap those markets. So if you look at the individual countries represented here, certainly no surprise with a lot of the more established household emerging market names representing a large percentage of the overall investable universe. But I think also one of the things that's striking is that although you are having a lower number of total issuers, overwhelmingly investment grade. So from this perspective, there is a bit of selection bias baked in to the EM local debt asset class. Now, contrasting this to the dollar-denominated variants of emerging market debt, we see EM corporate debt as having comparable yields to dollar-denominated sovereign debt in emerging markets. However, they're able to achieve those comparable yields with far less interest rate risk. And so how is that possible? Emerging market corporations trade at wider spreads than the dollar sovereign market. So yields are comparable, yet interest rate risk measured by duration in EM corporates is lower. Also comparing the number of issuers, certainly many more corporations headquartered in emerging markets than individual EM countries. So you're getting a much broader diversity of issuers as well as issues being offered in those markets as well. Looking at the individual country exposures, certainly the big story, and we'll touch on this in subsequent slides, is the rise in China in terms of its total contribution to the investable universe in EM corporates, rising to the top spot at approximately 20% of the index. But largely you see a lot of these countries appearing on both lists. However, I think one of the maybe key differentiators between these markets is that, yes, you do have more established emerging markets in the EM sovereign universe represented, but also you're going to see several other smaller, maybe less established emerging market countries represented in that particular index as well. And so if you're looking at kind of what the contributors are to yield, Mexico, Indonesia, Turkey, a lot of those individual markets on the dollar sovereign side are more comparable to U.S. investment grade corporates, whereas some of the lesser known maybe smaller, more troubled credits such as Venezuela or countries that are trying to make the transition from frontier markets to emerging markets ultimately pop up in this investable universe as well. In terms of the overall credit quality, between the two, you do see a fairly similar degree. But coming back to EM corporates in particular, in the chart on the right, it's interesting to note that the individual industries and the individual companies that are represented in the investable universe. So I think a lot of times whenever people hear emerging market corporates, they don't necessarily think about these large multinational corporations that really are operating on a global scale, but just so happen to be headquartered or have operations in emerging markets. And so I think one of the key things to keep in mind is that, in many regards, yes, there is exposure to, companies that are involved in commodities. So you've got oil and gas issuers as well as metals and mining companies. But really, their businesses are operating on a global scale. And so one of the kind of knocks against the dollar sovereign market, again, that original sin issue, is maybe mitigated a bit, given that a lot of these global players yes, have long-term debt denominated in U.S. dollars, but they're also going to have an overwhelming majority of their revenues denominated in U.S. dollars as well, as they're selling those commodities globally.
I think one interesting point just before you go to the next slide is the fact that, and Brad kind of alluded to, the transition of some countries from frontier to emerging within the USD sovereign space. In the bottom two rating categories, the B and the C, the USD sovereigns have 19%, while emerging market corporates only have 10% exposure. So it's 19 versus 10. So investors in USD sovereigns need to be very conscious of the risk that they're taking on the credit profile.
Again, touching back on this notion of going for emerging markets and yield, really this chart is looking at the evolution of all-in yields for U.S.-focused fixed income investors and contrasting that to emerging markets. So generally, if you want to increase the income potential of your portfolio, you really have two options. You can either invest in non-investment grade corporates, or you can go to emerging markets. And so I really think that the opportunity set in the current environment actually appears somewhat compelling. So looking at the orange line, EM local debt is approaching some of the highest levels that we've seen over the last 3 years from an all-in yield perspective. And I think one of the things that maybe is maybe forgotten by some investors is that, again, this segment of the fixed income markets remains overwhelmingly investment grade. Granted, you have exposure to currency risk, but the fact remains that the credit quality is still very high. On the EM corporate side, given that it does have a fair degree of exposure to a lot of those commodity-sensitive names, we have seen spreads and yields pressured higher over the last several months as commodity prices have fallen. But in our mind, it does seem somewhat interesting and potentially compelling comparing it back to recent history where, now for EM corporates, you're at some of the highest all-in yield levels that we've seen in recent history. So I think it's just something important to keep in mind that really for investors interested in emerging markets, the yield story is still largely intact. But maybe one of the most important slides, I would say, in this entire deck, and it's something that we have tended to talk a high degree about with a lot of our clients and various investors, is looking at what is the potential trade-off and how do I necessarily think about the opportunity of investing in emerging market local debt. So really, like the last slide had shown, yield appears fairly attractive given the trade-offs in credit quality. However, you are going to have exposure to foreign currency risk. So for a good rule of thumb for U.S.-based investors in thinking about their U.S.-based fixed income positions is that really the starting yield or the yield at which you buy a fixed income investment is really your best estimator or barometer for potential future total returns. So one of the benefits of being a bond investor and making kind of the key assumption that there won't necessarily be any defaults over the holding period of your investment, you can use math very simply to back out the total amount of return that you have by holding on to that investment through maturity. So if we look at a 5-year U.S. Treasury bond currently yielding 150 basis points, if we were to hold that security for 5 years until it matures, we could expect a cumulative return of approximately 7.6%. So really we can use that as our baseline to understand how much total return I can necessarily derive by going into foreign markets or going into emerging markets and investing in the higher yielding segments of the market. So if we look at India as an example, currently yielding close to 7.7%, over the holding period of that investment, you'd return approximately 38% on a cumulative basis. So really, to be indifferent relative to investing in that U.S. Treasury, you can see that the currency would need to fall by nearly 31% over the next 5 years for an investor to have the same total all-in return versus just investing in the 5-year Treasury. To provide some historical context, the far right column in this chart also shows the trailing 5-year FX performance. And so really, in the case of India, really the trade becomes that if the next 5 years, which have been fairly bad from a historical perspective in terms of the depreciation of the rupee against the US dollar, you would basically need to have that negative performance over the next 5 years, ultimately to have your investment in Indian bonds not necessarily pay. Certainly, higher yielding markets such as Brazil, which continues to be in the headlines. Again, near 16% yields on these investments. You're really having to make a fairly strong view on the currency that it would need to depreciate, by over 70% to ultimately break even against a 5-year U.S. Treasury bond. At current levels, a lot of these investments could appear compelling. Now, before we move on to the next slide, I think looking at some of the lower yielding segments of the market also provides some context. Certainly the cushion for currency depreciation is not necessarily as high in those markets, but you have to remember that also, again, one, those balance sheets tend to be fairly clean. They're very high credit quality, and also their exposure to lower commodity prices are also more limited. So again, you're maybe not deriving the same amount of income potential on the front end, but again, the overall quality of the underlying bonds that you're holding in your portfolio could appear compelling. So this slide largely represents some implementation ideas that investors might necessarily be able to take back to think about in terms of enhancing the overall yield of your portfolio. So largely for investors in the U.S., largely is one way to increase the overall yield is for them to go into higher yielding assets or U.S. high yield bonds. One alternative to that would be to potentially look to EM corporates as another potential alternative as a way to increase yield. So what we show in this slide is the spread the spread between EM corporate bonds relative to U.S. investment grade corporates. And so as you can see, at 321 basis points, this represents one of the highest levels really that we've seen in the asset class going back all the way to the global financial crisis. So another story that's necessarily been in the news has been the rapid expansion in emerging market credit. So really, if you look at the top blue line, this represents developed markets, and really since the global financial crisis, they've taken this opportunity to really pull back from lending, ultimately de-risking some of their balance sheets and ultimately shrinking the amount of leverage that's embedded in their financial systems. So as you can see, the green line representing emerging markets has had a fairly significant increase over this same time period. I think that one of the things that's maybe a bit misleading about this graph is that largely that expansion in the amount of credit is largely being driven almost solely by China. So the orange line underneath represents that same time series, however, stripping out China from the overall data set. And so really we're talking about two different markets here where you're seeing a fairly rapid expansion in credit from China and a more modest increase in emerging markets. And I think that one of the things that also maybe goes underappreciated here is that still we're at generational lows from an all-in investing or financing perspective. So really a lot of these emerging markets are simply taking advantage of very favorable terms. So I think in the long term it's fairly prudent for a lot of these markets to tap the demand that currently exists in the market, lock in longer-term financing rates, get away from being so dependent on bank loans to help finance their businesses, and ultimately term out their debt, reducing the risk that they won't ultimately be able to roll it over in the long term. So I think, again, this chart perhaps paints a slightly different picture than one that actually is occurring in the market, where, again, China is the primary driver of this expansion in credit. Again, getting back to the underlying quality of these assets, I think that this is actually fairly compelling in looking at kind of how emerging market corporations compare to their U.S. counterparts. So in the chart on the left, net leverage across virtually every ratings bucket is significantly lower than its U.S. counterpart. So ultimately, if we think back to the difficulties of the financial crisis, we know that having high degrees of leverage during an environment where credit conditions ultimately tighten is a very, troubling and worrying kind of result from tightening credit conditions. And so really the fact that emerging market corporates, again, have been prudently managing these risks is something that's many investors should ultimately take some heart in. In the chart on the right, it's actually telling the exact opposite story, where EM corporates, represented by the orange line, ultimately are paying significantly higher amounts of spread across virtually all ratings buckets. So in the triple B segment, a company that happens to be headquartered or have significant operations in emerging market is paying over 70 basis points more in terms of spread in order to borrow from financial markets. In the double B segment, you're more than 120 or nearly, 120 basis points greater in terms of the overall borrowing costs. And so I think that, again, putting the two together, net leverage lower in the case of emerging markets, yet their spreads and compensation for investors investing in emerging market corporates is higher. In my mind, that stands out as being a fairly compelling opportunity for global investors. So with that, I will turn it back over to Rick to look at some of the near-term challenges as well as potential opportunities in select emerging markets.
Well, yeah, basically over the last half an hour, you've heard basically the macro case as well as the fundamental case within the markets in terms of valuation opportunity. And overall, there is potential value that we see in the depreciation of the currencies and the widening that we've seen in spreads. And harking back to the earlier discussion and the long-term case for EM countries in terms of the long-term EM story, it might be a little bit dented, but it's largely intact and largely there for investors to take advantage of going forward. Obviously, uncertainty in China, commodities, and the Federal Reserve provide headwinds that we're going to have to deal with. But we do feel that if we see greater stability in China and commodities, that could go a long way in terms of providing the catalyst to leg into positions. We expect differentiation to continue among EM asset classes and country exposures, with fundamentals, particularly the reduction of external vulnerability, remaining critical in assessing relative value across EM. Now, obviously, there are risks there, and a disruption in China and another leg down in commodities would pressure and present broad challenges across the EM complex. But overall, we like Mexico currency, the corporate bonds. We like Indian debt. We remain very cautious about Turkish debt, and we'll discuss that in a little bit, and see both risks and opportunity in Brazilian local debt and corporate debt. And we think it's a touch oversold and sentiment's overly bearish. China has been key to a lot of part of our discussion, and it remains critical going forward. The market slowdown has really taken everyone by surprise. And I think earlier this year, with their bungling of regulating the equity markets, the only thing I can really think about to make an appropriate analogy is that their handling of the stock market really evokes the image of James Bond, all decked out in a tuxedo, dressed to the nines, sipping a martini, and all of a sudden he takes 2 steps and takes a header down the stairs. No matter how refined his appearance might be in the future, he can't shake that image of that stumble. The pristine veneer is rubbed off a little bit. And I think that's part of the issue I think people have with China right now. They were seen at their worst, and they were seen to be a little bit less than polished in the way they were going to deal. Nothing's really fundamentally changed about how they approach policy, but the perception that investors have has fundamentally changed. China still faces the industry struggling with overcapacity, particularly manufacturing and real estate, as it seeks to move in this transition to a more balanced economy. But the positive sign is that the consumer sector has been relatively resilient, and there's even been greater stability in real estate lately. On a stimulus side, currency policy easing should provide a tailwind to the economy in the coming months. Credit growth just recently hit a 10-month high. Budgeted fiscal spending is expanding at the fastest pace since 2012. And the Chinese government is not devoid of additional tools. They have more tools at their disposal to stimulate their economy than probably any other global economy at this point. The recent inclusion in the IMF special drawing rights basket, it's a little more symbolic than impactful right now, but it's an important symbolic landmark with a strict policy objective of the Chinese. The actual impact is going to be relatively mute, especially until it's implemented in September 2016. But it's likely to grow over time as more reserve managers become comfortable in using the Chinese currency within their reserve management and becomes a larger and more ingrained part of the global trading environment. That being said, a pronounced devaluation in the yuan remains a risk that we need to be very cognizant of, and it's particularly a risk to Asian currencies. And I think the most effective way to measure that and gauge those pressures is to look at the spread between the Chinese offshore spot rate and the level that the PBOC fixes the spot, otherwise known as the fixing rate. Now, preceding the devaluation in August of this year, the offshore rate was consistently about 1.5% to 2% lower than the fixing rate, and that was consistent over time. And that built up pressures in terms of potential capital outflows, as well as potential incentives to devalue the currency. And that's a risk to keep on and focus on this year. But turning to the more positive news at this point, fixed pans and other things. Well, we like Mexican currency and the Mexican corporate debt and local debt. We think Mexico has, in aggregate, been unfairly punished for its commodity-based roots. It's no longer a commodity environment anymore. It's one of the reasons why it's not in our commodity currency basket. And commodities contribute a relatively small amount to the overall GDP for Mexico. And if there's one economy's positioned to benefit from U.S. expansion, it's the Mexican economy. And we do think that the U.S. economy is probably going to surprise slightly to the upside next year. Now, in India, we've also seen a dramatic turnaround in terms of the implications of a credible central bank leader, as well as a reformist agenda. And they've done a great job restraining some of their external vulnerabilities and putting the country onto a path of fairly unique reform. Additionally, it's offering attractive rates. And we're seeing increasing access to local markets, both corporates and sovereigns. An interesting fact I learned today is the reform agenda in terms of bankruptcy code and adopting a bankruptcy code that's more similar to the U.S. in scope that is currently being discussed or is poised to be discussed in the government really could give a shot in the on-development of a very liquid corporate market within India. We think it's a tremendous opportunity, and we would suggest that investors look to take advantage of. An opportunity that investors might shy away from is Turkey in general, both the corporate side, the currency, as well as the local debt. And what we've seen is persistently high inflation and current account deficits have really upped the ante in terms of external vulnerability. We've had a dysfunctional government and central bank. Pressures between the two seem to intensify each year. There's a heavily indebted corporate bond sector. They've had rapid expansion in the corporate bond sector over the last 5 years. And an enormously large degree of their local debt is held by foreign participation, mitigating some of the benefits from original sin that issuing local currency might offer. So we would remain cautious about Turkish exposure. Another area in which we're very cognizant of the risks, but we think the risk might be, and the overall market sentiment might be overdone. And it's really hard to get on the platform with Brazil with impeachment hearings going on. But the sentiment is so poor in Brazil that we believe it's gotten to a point that even the Brazilian government can exceed the threshold that's been set. And local debt and corporate debt is offering extremely attractive income levels. Local currency debt is offering 16% at this point. A Petrobras issue due in 10 years is offering 10.5% in a year, and that's a dollar-denominated bond. And if any country is poised to benefit, given the broad reaches of its commodity resources, from an upturn in commodities, it's Brazil. And the fact of the matter is that you're paying over twice as much for protection on Brazil relative to Turkey, and it's consistently more on Brazil relative to Egypt in terms of protecting corporate credit risk. This doesn't seem to make much sense to us. Given that we see value currently, potential value in EM, and it's up to the conviction and the confidence in the long-term EM story and whether it's going to hold and whether it's going to be a near-term or a longer-term investment opportunity. We suggest that investors keep a very vigilant eye on developments in China, commodities, and how gradual will the Fed be. Will they be low and slow, or will they be hurried and rushed? I think it's going to be somewhere along the continuum, but it's probably closer to low and slow than hurried and rushed. And when these opportunities present themselves, we urge investors to take a look at the product set that WisdomTree offers in this space. We offer a full suite of debt products. We offer several currency ETFs providing exposure to some of the markets we've listed, including Brazil and India. And we have a full suite of equity ETFs that will allow you to harness the potential long-term story we see within EM. And we thank you for your time, and at this point, we'll take any questions.
Rick and Brad, thank you very much for that very, very interesting webinar. And we do have a few questions coming in from the audience, and I know since we did get a little bit of a late start, we'll run over a few minutes here to make sure that we can get to those questions. I know that we just covered a few areas that you guys like, such as Mexico and possibly Brazil, should the sentiment change there. But actually, what flavor of debt do you guys prefer when it comes to those markets and in general, in the EM space?
Yeah, so ultimately, I would think that really boils down to an investor's comfortability with taking non-dollar denominated currency risk. Again, as we highlighted in that slide, all-in yields for EM local debt certainly appear compelling. Certainly, the bet that you're making is that currencies find some level of stability. But I think really the trade, though, is that, EM currencies don't even necessarily need to appreciate. Largely if they hold serve, a total return from a 5-year duration investment yielding close to 7% in the current market environment appears, fairly compelling. On the dollar-denominated side, I think that EM corporates, again, with this idea that commodity prices show greater stability, I think the fact that that market has a shorter duration than the dollar sovereign market with comparable yields, I think in the face of an eventual move or likely move by the Federal Reserve, I think that market could also make a great deal of sense. So in conclusion, I think that EM local is your highest potential return, given that we find some stability in EM currencies, and then EM corporates is a nice complement to your core dollar-denominated fixed income portfolio.
Thank you for that, Brad. And you just did mention the Fed. I guess my next question for you would be what impact will the ECB and the Bank of Japan have on policy over in EM markets, on the EM assets as well?
I think it provides a nice little offset if they currently don't disappoint like Draghi did this morning. But we still see policy divergence between the ECB, the BOJ, and the Fed. Fed's moving to lift off, and the ECB and BOJ are nowhere near lift off and probably doubling down on QE as we speak. And it provides a little bit of an offset. In the context, it's not extreme. I can see a very sharp devaluation or steps to devalue the currency in Japan might eventually trigger some trade noise in terms of Asian currencies, and that might cause them to devalue the currencies a little bit. But overwhelmingly, it's good for the overall risk sentiment within the market, and which can not do anything but generally help EM debt on an overall basis.
Great, thank you for that, Rick. One of the things I think investors struggle with is finding, when is the right time to get into a market, and not that you guys would advocate market timing, but what are some of the catalysts or things that investors should be looking for if they were looking to increase their position or increase their conviction in EM debt?
I think it's positive signs from China. Having oil touch upon 40, 45, going up to 50 would be a tremendous sign. I think the graph I showed earlier, the growth premium, if there is a greater conviction, and we have seen some turn up in global growth in general in a lot of the PMI numbers, and if that continues, that's a good sign. Sentiment's getting a lot better, and basically there are some positive aspects of global growth, even though it might mean the Fed tightens a little more aggressively. So those are the signs I'll be watching. Stability in the China. Every day I think investors should take a look overnight what happened in China and what the economic data looks like to gauge where they are. It's going to be the driving force again next year.
Okay, good to know. And then along those lines, what fundamentals do you guys look at when you're assessing risks for emerging markets?
Yeah, sure. So it's like pretty much any other risky fixed income investment. So focusing largely on carry in the context of either interest rate risk or currency risk. Also, if we're coming back to a lot of those macro fundamentals, look, emerging markets represent a very broad and a very wide-ranging continuum of various opportunities. And so I think it's not necessarily a one-size-fits-all approach to the market. In our portfolio, in our emerging local debt portfolio, historically we've tended to bias towards a lot more of the Asian names, just given the fairly attractive growth rates, the comparatively low levels of debt, especially relative to the size of their economies. They tend to be slightly lower yielding than maybe some of the riskier, more commodity-centric names. But really what's added value throughout the most recent performance period has been, the dampening of currency risk in the portfolio. So again, I think by biasing the portfolio to higher quality, cleaner balance sheet countries, you're able to protect the portfolio a little bit more from some of the downdrafts that you've seen in currencies against the U.S. dollar.
And that's just to echo what Brad said, that's manifested itself in terms of the recent performance of ELD relative to the GBIEM, the global reference benchmark. The alpha that's been generated has been a significant reduction in the amount of money that's been lost on the currency side.
Great. Thank you guys for that. And we're just about out of time. So, one of the things I said in my opening remarks was to hope to leave people with a few ideas today that they could put into the market. What would be, if you had to kind of pick your, maybe, I don't know, let's say you want to call it your best idea and your worst idea, but if there was one country that you would certainly favor looking to go ahead and get into, and one country you're looking to avoid, what would they be? And you guys can split that any way you like. Rick, take one, and Brad, take the other, or however you'd like to answer that.
Yeah, I would put a relative value spread trade, 100 long India and Mexico and short Turkey. It was potentially to do that quickly and effectively. But I think there are opportunities in a lot of places, and it's just being very diligent and being very risk conscious and looking at the risks. But I would favor, from a commodity perspective, I would favor countries that have exposure to oil as opposed to metals. So I would favor going long Brazil versus going short Chile, for example.
Yeah, no, I would largely echo those sentiments as well. Yep.
Great. Well, guys, it looks like we're just out of time. I'd like to thank both Rick and Brad for participating on today's webinar. I'd also like to thank again our sponsors for the Emerging Markets Week. That's CSOP, that's WisdomTree Asset Management, JP Morgan Asset Management. Please do visit their website to learn more about their emerging market products and the solutions that they provide. Again, I would remind everybody that our last webinar tomorrow on the emerging markets will take place at 2 p.m. Eastern. That will focus on China and how to capture alpha in the China markets. A recording of today's webinar and a copy of the slides will be made available on ETF.com within 48 hours of today's webinar. As a participant in today's webinar, you will receive an email alerting you to those slides when they are available, and that email will also contain the information for your CE credits. But most of all, I'd like to thank our attendees for today's webinar. Again, we apologize for the late start. We had a little bit of technical difficulty, so we do appreciate you hanging in there with us, and we do appreciate you taking an hour out of your day to learn more about emerging market debt. For WisdomTree and ETF.com, this is John Swill saying thank you, and have a great day.